Welcome to the deep dive. I've been really looking forward to this one today because we're tackling a topic that is fundamentally reshaping the American landscape.
Yeah, it really is.
Yeah.
And in a way that most people don't see coming.
Exactly. It feels almost completely invisible, right up until you're the one caught right in the middle of it. So I want you to put yourself in a very specific scenario for a second.
Okay, let's hear it.
Imagine you get the call, you're sitting at your desk, phone rings, and it's the offer for an absolute dream job. And it's in a fantastic new city.
Always a good feeling.
Right. And we're talking about a massive, let's say a 40% salary bump. It's the kind of career leap that doesn't just change your title, it changes the trajectory of your entire life.
It changes your retirement date, kids' college options, all of it.
All of it. So you're celebrating, you're thrilled, you're probably already looking up moving companies and checking out neighborhoods online. But then you sit down on your couch, you open up a spreadsheet to do the basic, responsible math on housing in this new city, and your stomach just drops.
Because the math doesn't work.
It doesn't work. You realize, just staring blankly at those cells on your screen, that you have to turn down this dream job. You have to turn down a 40% raise.
Not because you don't want it.
Right, not because you don't want it, but because your current mortgage on your current house is simply too good to let go of. It has become mathematically irrational for you to accept a massive promotion.
It's a genuinely staggering position to find yourself in, having to choose between career velocity and housing stability.
Yeah.
And yet, this isn't some hypothetical thought experiment. It's precisely the reality for millions of Americans right now. We're looking at a situation where the fundamental mathematics of buying and owning a home completely broke by the time we reach 2026.
And that's the core mission of our deep dive today. We're going to explore exactly why that math broke and how it happened essentially by accident.
And the most challenging aspect of this, which we really need to emphasize up front, is that it wasn't caused by a housing crash.
Right.
It wasn't a subprime lending crisis like 2008. It wasn't some massive institutional fraud where bankers were hiding bad debt.
Which makes it so much harder to wrap your head around. So to guide us through this, we're pulling from a pretty heavy stack of institutional research today.
Some really robust data.
Yeah. Our primary source is Working Paper 2305 from the Federal Housing Finance Agency, the FHFA. We're also layering that with sweeping demographic data straight from the National Association of Realtors.
The NAR.
Right, the NAR, which gives us the human behavior side of the equation. And then we're grounding all of that in hard, verifiable market numbers provided by the Federal Reserve and Redfin.
Right.
So we are putting all these pieces together to give you a very clear map of this territory.
It's crucial we set the tone for this analysis right at the outset, too. This isn't an alarmist deep dive.
No, definitely not.
We aren't here to predict a catastrophic collapse or point fingers at some shadowy villain who supposedly ruined the housing market. What we're doing is taking a measured, analytical look at how millions of everyday people
making perfectly rational decisions.
Exactly. Making highly responsible financial decisions for their own families who accidentally ended up paralyzing the entire United States housing market. It is a masterclass in unintended systemic consequences.
Okay, let's unpack this. Because to really understand a macroeconomic trend of this scale, we have to start small. We have to look at the micro view.
The human level.
Yeah, the human level, to see how these massive economic forces actually play out at the kitchen table. So let's go back to that scenario we opened with, and let's put some names and exact numbers to it, drawing straight from the case studies in our research briefing.
Yeah, go.
We're looking at a couple, let's call them Priya and Daniel. They are professionals in their mid-30s living in Denver, Colorado, and the timeline for their story begins in March of 2021.
March 2021. That is a critical timestamp in economic history.
It really is.
Particularly for the real estate sector. The environment then was just unlike anything we've seen before or since.
Right. So in March 2021, Priya and Daniel close on a 4-bedroom house in Denver. The purchase price is $480,000. Now here's the golden ticket they acquired. They locked in a 30-year fixed mortgage at a rate of 2.9%.
2.9%.
2.9. That leaves them with a monthly mortgage payment of $2,002. So looking at that snapshot, they did everything by the book.
They absolutely did. When we analyze that specific decision in March 2021, it is a textbook example of a financially responsible move.
A total win.
Exactly. They purchased an appreciating asset, they secured a fixed cost of living for the next 3 decades, and they acquired capital at a historically anomalous low cost. Think about what 2.9% actually means in the real world.
It's basically free money.
It is. When you factor in historical inflation averages, which typically hover around 3%, securing debt at 2.9% is basically acquiring free money over a 30-year horizon.
From a personal finance perspective, locking in that rate on a $480,000 asset wasn't speculation. It was a highly defensive, highly advantageous wealth-building maneuver. They were playing the game exactly as the rules dictated.
They were the poster children for smart financial planning. But let's fast forward the tape. Let's jump 4 years into the future to 2025.
Okay.
Daniel gets a phone call. It's a major technology company based down in Austin, Texas, and they want him to join their leadership team.
The dream job call.
The dream job call. They are offering him a 40% salary increase. He is currently making $112,000 a year in Denver. This new role in Austin will bump him up to approximately $157,000 annually.
That's a $45,000 raise.
Yeah. In the grand scheme of a career, that is the kind of inflection point that changes your retirement age. It changes the kind of colleges your kids can look at. It's massive. It's a compounding opportunity. Because a jump like that doesn't just mean more money in year one. It resets your entire baseline for future raises, future bonuses, and just overall career leverage.
Right, because your next raise is based on that higher number.
Precisely. If your next raise is 5%, it's now 5% of a much larger number. By all conventional career metrics, you take that job. You pack your bags, you list your house, and you move to Texas.
I hear that, but surely people move for reasons other than just interest rates, right? I mean, life happens, people chase the money.
They usually do.
But Priya and Daniel don't go. They actually decline the offer. And this right here is the trap, the 2025 mobility trap. Let's look at the shocking math of why moving to Austin became literally impossible for them, despite that massive career carrot dangling right in front of them.
The spreadsheet moment.
This spreadsheet moment. They start looking at comparable homes in Austin. They want something similar to what they have in Denver, similar square footage, similar commute times, similar neighborhood safety profiles.
Apples to apple.
Exactly. In 2025, that comparable home in Austin is listing at approximately $520,000. Now, that is a little bit more than their $480,000 Denver home, but a $40,000 difference in purchase price isn't wildly out of the realm of possibility when you're getting a $45,000 raise, is it?
No, the purchase price isn't the trap. The trap is the cost of the capital required to make that purchase. In 2025, they are no longer getting a 2.9% interest rate.
Not even close.
The prevailing market rate shifted drastically, settling around 6.8%.
So let's run the numbers on a $520,000 home financed at 6.8%. Their new monthly mortgage payment, and this is just principal and interest, would be $3,412.
What's fascinating here is how quickly the math unravels when you look at the monthly cash flow differential. In Denver, their payment is $2,002. In Austin, for essentially the exact same physical standard of living, the payment is $3,412. That is a difference of $1,410 every single month.
When you annualize that, it is nearly $17,000 a year in additional housing costs just to tread water.
Just to stand still.
Yeah, you're paying $17,000 more a year just to keep the same kind of roof over your head. So let's apply that to Daniel's massive $45,000 raise. On paper, $45,000 sounds life-changing, but you don't get to keep all of that.
Taxes.
We have to factor in the reality of taxes. We have federal income brackets. We have FICA taxes.
Right.
Even moving to a state with no income tax like Texas, the federal government is taking a significant slice of that marginal increase.
A very large slice.
Once those deductions happen, what's actually hitting Daniel's checking account is significantly less than $45,000.
We can estimate that after marginal taxes, that $45,000 raise might translate to roughly $28,000 to $30,000 in actual take-home pay. Now, take that after-tax increase and subtract the additional $17,000 a year in pure mortgage interest and higher housing costs.
Wow.
The financial advantage of taking that massive promotion almost completely evaporates. You are left with maybe an extra $10,000 a year in net functional wealth. And remember, that's before we even discuss the transactional friction of moving.
Oh, right, the closing costs.
You have to pay 6% in broker fees to sell the Denver house. You have moving companies. You have closing costs on the new Austin house.
It's incredible when you map it out like that. When Priya and Daniel ran those numbers, they realized that a 40% raise would essentially leave them with the exact same amount of disposable income, but they would have reset their mortgage clock back to year one.
And taken on a vastly more expensive loan.
Right. The promotion becomes a total financial illusion. They are effectively blocked from advancing their careers because their current mortgage is too good. It's turned into a literal set of golden handcuffs.
It forces us to challenge our traditional understanding of what an asset actually is. A home with a locked-in 2.9% mortgage and accumulated equity is, technically speaking, a tremendous asset on their personal balance sheet.
Sure, on paper.
If you look at their net worth, it looks great. But functionally, in the real world of 2025, that asset paradoxically transformed into a geographical and professional cage. The mortgage became a liability to their career mobility. They're trapped by the unintended consequences of their own financial success.
I want to push back on that a bit, though, because is it really a cage if they are still living in a great house in Denver? I mean, they aren't suffering. They just missed out on an extra opportunity. If it were just one couple in Denver missing out on one job, it would be an interesting anecdote for a dinner party.
You're right that they aren't suffering in the traditional sense of financial ruin. They aren't going hungry. But the macro effect of millions of people making that exact same choice is where the systemic damage occurs.
Here's where it gets really interesting, because it isn't just Priya and Daniel, it's an entire generation of homeowners. Let's transition into the macro scale and talk about how we quantify this lock-in effect.
The aggregate data.
Yes. Our primary source for this is Working Paper 2305 from the Federal Housing Finance Agency. Let's give some context on the FHFA. For someone who doesn't track housing policy day to day, why should we care what this specific agency has to say?
Well, the FHFA is the regulatory body that oversees Fannie Mae, Freddie Mac, and the broader government-sponsored mortgage market. They aren't a think tank doing opinion polls.
They have the real numbers.
Exactly. They possess visibility into the actual ground truth mortgage data of tens of millions of American households.
Yeah.
When they publish a working paper on housing dynamics, it represents some of the most rigorous, data-rich institutional analysis available globally. So when they attempt to measure a phenomenon like the rate lock-in effect, they are doing it with a near-complete census of the mortgage market.
And their findings for the first quarter of 2024 are staggering. According to the FHFA data, as of Q1 2024, 85.7% of all mortgaged homeowners in the United States held a mortgage rate that was below the current market average of 6.46%.
Let that number sink in.
I'll repeat it so it really sinks in for you. Nearly 86%. Almost 9 out of every 10 people who have a mortgage in America are sitting on a rate lower than what they could get if they bought a house today.
Think about the structural imbalance that creates. You have a massive supermajority of the market mathematically incentivized to stay exactly where they are.
Yeah.
And they aren't just mildly incentivized, they are dramatically incentivized. The FHFA didn't just point out the discrepancy. They developed a mathematical formula to predict how this specific gap affects human behavior. This is what we refer to as the 18.1% rule.
I love when we get a concrete rule. Break that down for us. How does the math actually work for the listener?
The researchers found that for every single percentage point difference between a homeowner's existing locked-in mortgage rate and the current prevailing market rate, the probability of that homeowner choosing to sell their house drops by 18.1%.
Wow.
It's a linear, measurable suppression of market activity.
So if you're listening right now and you bought a house in 2020 or 2021, pull up your mortgage statement in your head. Look at that 3% rate. Now look at what rates are online today. For every percentage point difference between your current rate and what you see online, the FHFA says you are 18% less likely to put a for sale sign in your front yard.
That's the math.
So let's bring Priya and Daniel back into the room and apply this 18.1% rule to them. Their locked-in rate from 2021 is 2.9%. The prevailing market rate for their hypothetical move to Austin is 6.8%.
Right.
If we subtract 2.9 from 6.8, we get a gap of 3.9 percentage points.
Now, multiply that 3.9-point gap by the 18.1% suppression factor per point. You arrive at a highly specific conclusion. Priya and Daniel's probability of selling their home, all other things being equal, is suppressed by roughly 70% compared to a baseline homeowner who already has a market rate mortgage.
A 70% drop in the likelihood of selling. That is a massive behavioral shift.
It is. And we have to remember, they aren't acting out of stubbornness or fear. They are responding with absolute mathematical precision to the specific incentive structure the macroeconomic environment created for them.
Right, they're just being smart.
If a corporation made a decision that preserved $17,000 a year in cash flow at the cost of changing headquarters, we'd call it brilliant corporate strategy. Homeowners are just acting as rational economic agents.
But when you have almost 9 out of 10 homeowners acting as rational economic agents and collectively refusing to sell, it breaks the broader ecosystem.
Completely breaks it.
Let's look at the systemic fallout. The FHFA working paper estimated that this lock-in effect literally wiped out approximately 1.3 million home transactions between 2022 and 2024.
Over 1 million homes.
1.3 million homes that simply weren't bought or sold because the sellers were trapped by their good rates.
To contextualize the scale of that void, we have to look at what a normal, healthy housing market looks like in the United States. Historically, we typically see between 4 and 6 million existing home sales per year. When you remove 1.3 million transactions over a 2-year period, you are essentially erasing roughly a quarter of a year's normal transaction volume from the market entirely.
That's where the localized impacts start to ripple out, don't they? It's not just the buyer and seller who miss out. Think about the secondary economic victims.
Peripheral industries.
Yeah. When 1.33 million homes don't sell, that means 1.33 million title insurance policies aren't written. It means mortgage brokers don't get commissions. It means moving companies have empty trucks.
Contractors don't get hired.
Right. New homeowners aren't going to Home Depot to buy paint and lumber for renovations. The local tax revenues driven by transaction taxes vanish. It's a massive drag on local economies that rely on housing velocity.
The economic footprint of a single home sale is vast, and you're right to point out the localized drag. But the most severe consequence of those missing transactions is what it does to the fundamental laws of supply and demand.
Because life doesn't stop just because interest rates go up. You have a massive freeze in supply, millions of homes not hitting the market, but you still have people graduating college, getting married, having kids, getting divorced, needing to relocate for family.
The demand is persistent.
Demand doesn't drop at the exact same rate as supply. And what happens when supply drops off a cliff but demand remains relatively sticky? Prices go up.
It's the inevitable downstream consequence. The FHFA quantified this inflation effect as well. They estimated that this lock-in effect, operating purely through this mechanism of supply suppression, added an artificial 5.7% to national home prices between 2022 and 2024.
Let's ground that math for you so you can really feel what that means if you're out there shopping for a house today. Let's take a median-priced home of $400,000. A 5.7% artificial inflation on that home equals $22,800.
22 grand.
That's $22,800 in pure price inflation. It has nothing to do with the house being better. The kitchen wasn't remodeled. The roof wasn't replaced. It has nothing to do with the cost of lumber or copper or construction labor going up.
Just scarcity.
It's an invisible tax added to the price of the home, caused exclusively by the immobility of the pandemic-era buyers who mathematically cannot afford to sell.
This is a point we really need to emphasize because it runs counter to how we usually discuss economic crises in the media. There are no villains in this specific dynamic.
No evil bankers.
Exactly. There's no corporate greed driving this specific $22,000 premium. There are no predatory lenders tricking vulnerable people into bad loans. It is simply a system producing a highly predictable, mathematically certain harm as a direct consequence of its own success in 2020 and 2021.
It's just math.
The people who secured those sub-3% rates are benefiting immensely in their monthly cash flow. But their rational behavior to maintain that benefit is the exact mechanism making housing dramatically more expensive and less accessible for everyone who wasn't lucky enough to buy before the rates changed.
It's a perfect accidental storm. You've got this massive cohort pulling up the ladder behind them, not out of malice, but out of necessity. And the people who are caught in the absolute worst part of this storm, the ones left standing at the bottom looking up, are the ones trying to buy their very first home.
The first-time buyers.
Right. Let's pivot and look at the generational toll this has taken. We're talking about the first-time buyers and the completely inverted math of the American dream. We have incredible data here from the National Association of Realtors, the NAR. They publish an annual report called The Profile of Home Buyers and Sellers.
It is worth noting the pedigree of this data. The NAR has been tracking these specific demographic metrics meticulously since the early 1980s.
So we have a long baseline.
We do. When we look at their 2024 report, we aren't comparing it to a volatile 3-year window. We're comparing it against decades of deeply established, multi-generational historical baselines. We're looking at a severe historical divergence.
And the divergence is genuinely heartbreaking if you're a younger millennial or Gen Z trying to start a life. According to the 2024 NAR data, which covers the period from July 2023 to June 2024, first-time buyers represented only 24% of all home sales.
24%.
24. Since they started tracking this in 1981, through the dot-com bust, through the 2008 financial crisis, that is the absolute lowest share of first-time buyers ever recorded.
To see how steep that drop is, you have to look at the historical norm. Traditionally, first-time buyers represent a very steady 38 to 40% of the housing market. They are the demographic engine of the entire real estate ecosystem.
Right, they fuel the whole thing.
This raises an important question, because the housing market isn't just a collection of isolated transactions. It's fundamentally a chain. It is a sequence of dominoes.
A move-up buyer.
Yes. The vast majority of existing homeowners cannot afford to buy their next house, the bigger house for their growing family, the relocation house for a new job, unless they can sell their current house. And they usually need to sell their current house, often a smaller starter home, to someone entering the market for the very first time.
Someone has to buy the bottom rung.
Precisely. The first-time buyer provides the fresh liquid capital that allows the existing homeowner to move up the ladder. When you block that foundational cohort from entering the market, when they drop from 40% down to 24%, the entire chain seizes up. The dominoes stop falling. The starter homes don't sell, which means the mid-tier homes don't sell, and the market paralyzes from the bottom up.
The engine has stalled, and you can see the deep personal toll this is taking when you look at the age demographics. The cultural milestone of buying a house in your late 20s or early 30s is vanishing. The NAR data shows that the median age of a first-time homebuyer in 2024 jumped to 38 years old.
38.
The historical median for decades has been 31. We are looking at an entire generation of people who have had their primary vehicle for wealth accumulation delayed by 7 full years.
7 years might not sound like a lifetime, but mathematically, that delay has massive compounding effects on their lifelong wealth trajectory.
Oh, absolutely.
Homeownership has been explicitly sold to the American public for generations as the safest, most reliable way to build middle-class wealth. You buy a house, you pay down the principal, the asset appreciates, and eventually you have a nest egg to borrow against or retire on.
That's the dream.
Arriving at the closing table 7 years later than your parents did means you have 7 fewer years of equity paydown. It means 7 fewer years of asset appreciation. And crucially, it means 7 more years of paying rent that yields 0 return on investment.
That rent money is just gone.
If you're paying $2,000 a month in rent, that is nearly $170,000 in unrecoverable capital over those 7 years.
I think we need to pause on that because it changes the whole timeline of adulthood. If you don't buy until you're 38, maybe you delay having kids because you want the stability of a house first. Maybe you can't save as aggressively for your kids' college because your mortgage isn't paid off until you're 68.
The cascading effects are profound.
The domino effect on family planning and retirement is huge, and when they finally do arrive at the closing table at age 38, the financial reality they face is crushing.
Let's bring in the data from Redfin and the Federal Reserve to look at the human cost of this delay. Redfin's research shows that the monthly mortgage costs for first-time buyers are roughly 96% higher today than they would have been for the exact same home in 2019.
A 96% increase in the monthly cost of an identical physical asset in a span of just 5 years. That vastly outpaces any corresponding wage growth over the same period.
By a mile.
Even if you got promoted twice since 2019, your housing costs doubled.
It practically doubles the expense for the same 3 bedrooms and a yard. You have to ask, how are people actually affording this? How is a 38-year-old first-time buyer managing a mortgage payment that's twice as high as it was 5 years ago?
They're finding a way, but it's not sustainable. Well, the New York branch of the Federal Reserve gave us the answer, and it is a massive red flag for the health of the consumer. Their data shows that 56% of people who purchase homes in recent years have had to take on additional non-mortgage debt just to maintain their pre-purchase standard of living.
Let's look at what that actually means on the ground, because non-mortgage debt sounds kind of sterile.
It sounds like a car loan.
When people traditionally buy a house, they might take on some debt to furnish it, to buy a lawnmower, to do some minor cosmetic renovations. That is expected consumer behavior. But that isn't what the Fed data is capturing. The data is showing that more than half of recent buyers are utilizing credit cards, personal loans, or auto loans simply to bridge the gap between their massive new mortgage payment and their daily living expenses.
Imagine signing the papers on a $500,000 home, popping the champagne, taking the photo with the keys, and then realizing a month later you have to put your weekly groceries on a Visa card with a 24% APR just to keep the lights on.
It's terrifying.
They're financing their groceries, their gas, their utility bills because the house consumed all of their liquidity. They are running a monthly deficit against their own expectations of what homeownership would feel like.
It is the definition of being house poor, but on a systemic level.
Yeah.
The asset that was supposed to make them financially secure is actively degrading their monthly financial stability. They are trading long-term, illiquid equity for immediate, high-interest consumer debt.
It flips the whole script. You buy the house to be secure, and the house forces you into credit card debt. And this leads us to perhaps the most shocking data point in the entire briefing, the one that truly inverts decades of conventional wisdom.
The rent versus buy dynamic.
Yes. We've all heard the golden rule of personal finance from our parents, right? Rent is throwing money away. Buy a house as soon as you can. Pay yourself. Don't pay your landlord. It's practically an American commandment.
It's ingrained in the culture.
But Redfin's data from September 2024 completely shatters that narrative. Their research revealed that in the majority of major U.S. metropolitan areas, buying a home was 29% more expensive on a month-to-month basis than renting the exact identical property.
The rent versus buy inversion. It is a profound structural shift that requires a complete rethinking of personal finance. Historically, buying a home carried a premium, maybe a 5 to 10% premium over renting because you were gaining equity and control over the property.
You pay a little extra for the privilege.
You paid a little more monthly for the privilege of ownership. But a 29% premium fundamentally alters the calculus. If renting an apartment costs you $2,000 a month, but buying the exact same unit, the same square footage in the same building, costs you $2,580 a month in principal and interest alone, the conventional wisdom breaks down entirely.
Wait, let me challenge that. Sure, it's 29% more expensive today, but rent goes up forever. A fixed-rate mortgage stays the same for 30 years. Eventually, those lines have to cross, right? Isn't buying still the better long-term play?
That is the traditional counterargument, but it ignores the unrecoverable costs of homeownership and the opportunity cost of capital.
Yeah.
That 29% premium Redfin cited is just the baseline principal and interest. It doesn't include property taxes, which reassess and go up as the home value rises. It doesn't include homeowners insurance, which has skyrocketed in many states due to climate risks. It doesn't include the 1 to 2% of the home's value you need to spend annually on maintenance, the roof leak, the broken HVAC system, the new water heater.
Which you don't pay for when you rent, you just call the super.
Yeah, precisely. Now factor in the opportunity cost. If you buy a $500,000 home, you might put down $100,000. That capital is now trapped in an illiquid asset. If you had rented that $2,000 apartment instead, and you took that same $100,000 down payment and invested it in an S&P 500 index fund, and then you took that $580 monthly savings, the difference between the mortgage and the rent, and invested that in the market every month.
The compound growth.
The compound growth of that liquid portfolio over 10 or 20 years would, in many modern markets, vastly outperform the net equity gain from the house, especially when you subtract all the unrecoverable maintenance and tax costs.
So for a mobile professional without massive generational wealth to cover all these hidden costs, the mathematical instruction to buy as soon as you can is entirely inverted. It has become, in many cases, mathematically disastrous to buy. It ties up your cash, limits your mobility, and forces you to underperform against simple, liquid market investments.
In the current rate environment, yes. The math simply doesn't support the cultural narrative anymore.
So what does this all mean? We've looked at Priya and Daniel trapped in Denver, unable to take a life-changing promotion. We've looked at the massive supply freeze and the $22,000 inflation tax on every home. We've seen first-time buyers pushed out to age 38 and forced to take on credit card debt just to buy groceries. How did we get here? How did the greatest wealth-building engine in American history become a trap for the middle class?
We have to look at the macro picture.
Right, and specifically the dilemma faced by the Federal Reserve.
If we connect this to the bigger picture, we have to look closely at the Federal Reserve's rate policy between 2020 and 2023. It's critical to understand that the lock-in effect and all the paralysis we're discussing today was absolutely not an intended feature of their policy.
They weren't plotting this.
Nobody sat in a boardroom in Washington, D.C. and said, let's trap millennials in their starter homes and destroy housing mobility. This was an emerging consequence, a severe side effect of trying to solve a much larger, much more terrifying crisis.
We have to go back to early 2020, the onset of the pandemic. The global economy essentially shuts down overnight. Now, the Fed operates under what's called a dual mandate, right? Their job is to ensure price stability, meaning controlling inflation and maximizing employment.
Correct.
In the second quarter of 2020, we're staring down the barrel of the sharpest economic contraction since the Great Depression. The Fed looks over the cliff at total economic ruin, and they pull out the biggest monetary bazooka they have.
They moved to the most accommodative monetary posture in modern history. They cut the federal funds rate essentially to zero, but lowering the baseline rate wasn't enough to stabilize the panic. They engaged in massive quantitative easing. Specifically for the housing market, they began purchasing mortgage-backed securities at a blistering pace of $120 billion every single month.
Let's pause on quantitative easing and mortgage-backed securities. We hear those terms thrown around on financial news all the time, but for the listener who isn't a Wall Street bond trader, what does the Fed actually do when they ease quantitatively? Walk us through the mechanics of a mortgage-backed security.
Think of it this way. When you go to a local bank and get a mortgage, the bank doesn't usually hold on to that 30-year loan. It ties up too much of their capital. Instead, they bundle your mortgage with thousands of other mortgages from across the country into a single financial product, a security, and they sell that bundle to investors on the open market. This gives the bank their cash back immediately so they can go write more mortgages.
So the bank is basically a middleman.
Exactly. But in March 2020, investors panicked. Nobody wanted to buy these bundles because nobody knew if homeowners would keep their jobs to pay their mortgages. If investors stop buying the bundles, banks stop writing mortgages, and the entire housing market instantly collapses.
Total freeze.
So the Federal Reserve stepped in and became the ultimate buyer of last resort. By committing to buy $120 billion worth of these bundles every month, the Fed removed all the risk for the banks. This flooded the banking system with liquidity specifically earmarked for housing. It allowed lenders to drop consumer mortgage rates down to 2% and 3% because they knew the Fed was standing right behind them with an open checkbook.
The goal was to keep home financing artificially cheap, support the construction industry so home builders wouldn't go bankrupt, and prevent a total housing market crash that would have plunged us into a deep, dark depression. And we have to acknowledge, looking back at the data, the objective success of that massive intervention.
It worked.
It worked. Home building stabilized. The housing market didn't crash in 2020. People didn't lose their homes en masse to foreclosure like they did in 2008. In fact, refinancing volumes hit record levels. Millions of households refinanced at 2-point-something%, dramatically improving their personal balance sheets by freeing up hundreds of dollars a month in cash flow. Defaults stayed incredibly low. They successfully averted the disaster they were looking at.
They saved the ship from sinking.
Yeah.
But in doing so, they inadvertently flooded the engine room. Because as the economy stabilized and reopened in 2021, a new monster emerged. Inflation.
Right.
We had massive supply chain disruptions globally because factories were shut down. We had trillions of dollars in fiscal stimulus injected directly into consumer bank accounts. We had massive pent-up demand for people who had been locked inside for a year. It was a perfect textbook recipe for severe price instability. Inflation surged, accelerating through 2021 and becoming a roaring fire by 2022. The Fed was forced to reverse course to fight the very inflation their accommodative policies had helped foster.
It's actually a bit unsettling when you look at how hard they had to hit the brakes. They executed 11 consecutive rate hikes between March 2022 and July 2023. 11 hikes in barely over a year. That is the fastest, most aggressive pace of rate increases we've seen since the era of Paul Volcker in the early 1980s. They were desperately trying to cool down an overheating economy by making money wildly more expensive to borrow.
And that aggressive hiking cycle is what created the incredible distortion in the 30-year mortgage market. Let's trace the exact path of the numbers because this is the roller coaster that broke the structural math of housing. In January 2021, the average 30-year fixed mortgage rate bottomed out at 2.65%. Less than 3 years later, in October of 2023, that exact same 30-year rate peaked at 7.79%.
That is a movement of 5.14 percentage points in less than 36 months. It doesn't sound like a massive number when you just say 5%, but we have to make this concrete. We have to show what that mathematical swing does to a human being trying to buy a house. Let's go back to our $400,000 loan example. Let's look at the buyer in 2021 versus the buyer in 2023.
At the bottom, in January 2021, a $400,000 mortgage at 2.65% resulted in a monthly principal and interest payment of approximately $1,607. It's incredibly affordable for a dual-income middle-class family.
Now, fast forward to October 2023. You're buying the exact same house. You're taking out the exact same loan amount of $400,000, but the rate is now 7.79%. That monthly payment rockets up to $2,862.
You're looking at a difference of $1,255 every single month. That is $15,060 every year, multiplied over the 30-year life of the loan. It is a staggering, life-altering penalty. And we have to ask, what did the buyer in October 2023 do wrong to deserve a $15,000 annual penalty compared to the buyer in January 2021?
Absolutely nothing.
Absolutely nothing. They were simply a few years late to the market. Perhaps they were still in graduate school in 2021. Perhaps they were diligently saving for their 20% down payment. The macro environment shifted violently beneath their feet, punishing them for their timing.
It feels incredibly unfair, but we have to maintain our impartial stance here. The research is very clear on this. The Fed's intervention in 2020 was necessary to prevent a global economic depression. But the costs of that intervention were not distributed equally across the population. The benefits were entirely captured by the people who were in a demographic and financial position to buy or refinance in 2020 and 2021. The costs, the higher rates, the inflated prices, the lack of inventory were disproportionately shoved onto the shoulders of future buyers, the younger generation, and mobile workers like Priya and Daniel who need to move for their careers.
There was no clear alternative policy path that would have magically avoided all pain.
Right. The Fed had a binary choice, and they chose the path that saved the present at the heavy, heavy expense of the future.
It is the defining feature of the housing market in 2026. The system produced an outcome where individual rationality imposes massive, unavoidable costs on others. Priya and Daniel are living rationally inside their decision to stay in Denver. But the collective structure of 40 million households making that exact same rational decision simultaneously has resulted in a collectively irrational outcome for the nation as a whole.
It's a paradox. It really is. As we synthesize this entire deep dive, the overarching theme is undeniable. The housing market in 2026 isn't collapsing. We aren't seeing foreclosures everywhere. It's not chaotic in the way 2008 was. It is actually functioning exactly as it is mathematically incentivized to function based on the rate structures currently in place.
But it's broken in a much more subtle, durable way. It is a system that now serves a significantly smaller proportion of the population. It operates at a vastly higher cost to the consumer. It permits far less geographical and economic mobility than at almost any point in modern history. And the primary mechanism driving all of this isn't malice, it isn't fraud. It is the aggregated rational behavior of millions of people who did exactly what they were supposed to do. Priya and Daniel aren't a cautionary tale of greed. They are a lens.
A lens to view the whole system.
They're the lens through which we can understand how a complex macroeconomic system can naturally produce outcomes that nobody designed, nobody wants, and crucially, that the system itself currently has no clean mechanism to correct.
Which brings us directly to you, the listener. We want you to take a moment and reflect on your own views of homeownership. How does understanding this lock-in effect change your perspective? We've been told our whole lives that treating a primary residence as the ultimate financial goal is the key to stability. But when you look at how fragile that system actually is, how easily a shift in federal interest rates can turn an appreciating asset into a geographical trap, do you still view buying a house the same way?
It requires a paradigm shift in how we evaluate financial risk. The risk isn't just that the house might lose value in a crash. The hidden risk is that the house might permanently anchor you to a geography or a job that no longer serves your growth.
And I want to leave you with one final, lingering, provocative thought to mull over on your own. We've seen that the housing market has no clean way to correct this gridlock anytime soon. We've seen that the math of owning versus renting has fundamentally inverted in most major cities. So, are we blindly holding on to an outdated version of the American dream? Are we chasing a ghost? And furthermore, if we look closely at the data, which we'll be doing in future deep dives, and we realize that there are other asset classes out there that have quietly outperformed homeownership over the last 15 years. Assets that carry absolutely none of the illiquidity, none of the unexpected maintenance costs, and none of the geographic traps. Why is the financial services industry so heavily incentivized to keep us endlessly chasing a broken real estate market? Think about who really benefits when we all believe we must buy a house to be successful. We'll let you chew on that one. Thank you for joining us on this deep dive. We'll see you next time.